Good morning. Welcome to Trading Hour. I am Rima Tendulkar. With me are Sonia Shenoy and Pavitra Pari. Good morning, girls. The lay of the land appears to be focus on the bad news, react to the bad news, but ignore the good news, right? The case in point today is Bajaj Finance. When we woke up to the Q3 business update, on one hand, we had the the highest ever new loans at 7.8 million, right? That's good news. But on the flip side, an AUM growth of 27% on a year-on-year basis missed expectations. But the markets are choosing to focus on the moderation or the miss in the AUM growth, which is why the stock is now down close to about 7%. So the focus or the market texture now appears to be focus on the bad news, react to that, but ignore the good news. FMCG as a sector is doing well after Marico signaled an improvement in demand. And here I'm reading the line from the BSE release where they say during the quarter, the sector witnessed some improvement in demand, which was more visible in specific categories buoyed by the festive fervor and the oncoming winter season. So that's lifted the spirits of the rest of the FMCG pack like Britannia, ITC, Tata Consumer, Nestle, HUL. These are stocks where you can see across the board pretty good gains. Britannia is now up close to about 3%. On the losing side, as we said, it's the Bajaj twins, Bajaj Finance and Bajaj Finserv under severe pressure. But the combined weight of these two stocks in the Nifty is quite negligible, just 2.2%, which is why they're not exerting significant downside. The pressure on the index today is coming in from ICICI Bank as well as HDFC Bank. HDFC Bank lower for the second day in a row. So give and take all of that, right now as we speak, it's pretty flat on the benchmark indices, just down 9% on the Nifty, while the mid-caps are managing to hold up with a fractional gain of 0.1%. So quiet, you would have to say, digesting all the news flow below the surface.
Absolutely. When you said lay of the land, I thought you were going to talk about the layoffs, right? At Amazon, I mean, what?
And Salesforce.
It's amazing.
Yeah.
18,000 people going to be laid off, and that's like 6% of their workforce, right? And much higher than what they were talking about earlier. So I guess that's going to be the big global headline. And you can see the caution in the system as well, right? I mean, there's a risk-off sentiment that's back globally. That's putting a lid on our market gains as well. The Fed officials are indicating that there could be higher rates for some more time. So slower growth, more layoffs, higher interest rates doesn't bode. It's not a good cocktail at all for risky assets like equities. For our own markets, I guess a couple of levels do assume significance. One is the December lows of 17,800. So let's see if that holds. For now, at least it's a couple of 100 points away. The near-term resistance level on the upside, there's of course 18,200 and then there's 18,660, which was the peak we hit on the 14th of December. There's so much data that's coming out in the next couple of days. Tomorrow, there's the non-farm payroll, there's the hourly wages, there's the unemployment rate in the US. So that's going to determine, the way forward. But for our own markets, there are still pockets of growth that we're seeing. So I guess, we'll focus more on that. But the overarching theme, continues to be one of a bit of caution.
Oh, absolutely. In fact, we were listening into Satya Nadella also speaking, right? And that is the same tone that this challenging environment is likely to stay for at least the next couple of years. 2 years is what he said. India stands out amid, what's happening globally. But he does expect that this sort of tough global setup will stay for the next few years. In terms of stocks and sectors, we've already pointed out it is FMCG and the consumer pack which is holding up well. Banks, financials under pressure today on the back of course, led by Bajaj Finance, what's going down. The future group of stocks also, seeing pretty sharp cuts come through. So do keep those on your radar. In terms of key cues to track now, with the FOMC minutes out of the way, we will look at the jobs report on Friday. That is important for us to track. And of course, what's going on with crude prices. There was a big 5% drop overnight, 10% gone in 2 sessions. So bodes well for India, but let's see how that's headed because it's really been shaky and all over the place, really. So that is important to track as well. We are going to come back to the market action, but first up, let me run you through everything that we have for you on the show today. The market gives up opening gains, key indices near the flat line, while mid-caps mildly outperform. To discuss where indices are headed from here and what are the key levels to track, we will be joined by Rohit Srivastava of IndiaCharts.com.
All right, and Bajaj Finance and Finserv are the biggest losers on the Nifty this morning. We get you details on what's driving the down move in some of these stocks in just a bit.
And later on the show, we will be joined by the management of Rama Steel Tubes to discuss the company's third quarter business update. So that conversation also lined up.
And finally, we will focus on some important brokerage commentary on what 2023 holds for the auto and pharma sectors. All this and much more in the next 60 minutes.
Top of mind is certainly the big slide that we're seeing in Bajaj Finance and Bajaj Finserv, the biggest Nifty losers this morning. Remember, Bajaj Finance reported its third quarter business update post-market hours yesterday. Abhishek is joining in to tell us more about what has disappointed the street and what brokerages are making of the update. Abhishek.
Well, Rima, as you mentioned, brokerages are not happy with the loan growth that was seen in Bajaj Finance. They say that the AUM growth of 27% YOY is perhaps below their estimate. The customer addition has been strong. Number of loan booked is in line with what they were estimating. However, sequential loan growth in Q3, despite seasonally a strong quarter for Bajaj Finance, given the fact that there is festive spends that happen, Q3 is, this time around a lower loan growth in terms of the last 10 years. If you take a look at the average, this time around the loan growth of 14% is on the lower side in 10 years. So either there was some festive spend which happened in 2Q, or the company has lost market share versus peers or other lenders. So they see loan growth moderating from current levels of 27% going ahead. Now, amongst brokerages, we have Macquarie, who has an underperformed rating on the stock with a target price of 5,275 per share, and we also have CLSA, who have a sell rating on the stock with a target price of 6,000 per share. Back to you.
Okay, thanks for that. Well, RBL Bank is also buzzing after a strong third quarter update, while the RBI has lifted restrictions on recoveries via outsourcing for M&M Finance. Abhishek, what are you picking up on all of that?
For RBL Bank, what a loan growth is one of the best that you are seeing in last 3-4 years, either on YOY as well as on sequential, that is quarter on quarter. And CASA ratio, that's uptick trend against peers, is one of the best that they have recorded ever. So deposit growth on a YOY basis of 11% is one of the best in 5 quarters, and sequential deposit growth of 3% is the best that you are seeing in 3 quarters. So loan growth 14% YOY is the best in last 3 years, while 5.8% sequential loan growth is the best that you are seeing in last 15 quarters. The credit deposit ratio has improved, so in a rising interest rate scenario, this could mean that the net interest margin could expand on a sequential basis. CASA ratio, that is the low cost deposit ratio, unlike peers, has actually increased for RBL Bank and is the highest ever that they have recorded at 36.6%. Coming on to Mahindra Financial, now RBI had directed in September 2022 to immediately cease recovery process that they carried out via outsourcing arrangements. So this restriction has now been lifted with immediate effect. So restrictions have been lifted after the fact that, company informed RBI that the recovery practices and outsourcing arrangements have been changed. They have tightened the process of onboarding third-party agents unlike earlier, and they have strengthened the accountability framework as per the board. They have given it to board and got an approval for the same. Back to you.
All right, Abhishek, thanks a lot for getting us all of the details on these companies. But with that, it's time for a short break. On the other side, we'll discuss what's going on in the world of commodities. We'll also tell you about tire stocks which are buzzing around because of lower crude and rubber prices. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. We were talking about the FMCG space doing very well. Godrej Consumer also had its Q3 update released just a short while ago. So that stock is doing very well. It's up over 2%. But in addition to the consumer names, you have a lot of the auto stocks also which are finding themselves among the top gainers. I'm talking about the larger names, so the likes of Bajaj, you have Hero, Eicher, all of these doing quite well. In fact, we were talking to the Eicher management and they're also saying that, they expect the demand to only pick up going forward. They're also trying to cut down on discounting, so that will of course work well for the auto companies. But that's what's going on with the world of equities. Let's talk about the commodity space now. Manisha joins us, and today she is going to tell us about the metals pack. Manisha.
Pavitra, thank you. Well, we've started 2023 also on a weaker note for the metal prices. Not just energy, but the metal prices have been declining as well. And even as we've entered 2023 with the lowest LME stocks in last 25 years, but the concern really is about the weak economic data and on-ground actual demand there. So when you look at the PMI numbers that have come in from US and China for the month of December are at a multi-month lows. And then IMF has already warned about slower growth demand for major consumers like US, China and Europe as well. And then you have surging COVID cases and rising death toll in China. That continues to weigh on to most of these markets as well. China Lunar New Year holidays will begin in the third week of January, and many of the factories do remain shut for a couple of weeks at that point in time. And even before that, we haven't seen any restocking begin, and that seems to be bothering the markets. And that, by the way of example, can be seen in case of copper, where we have seen the premiums continue to decline. It was at $150 per ton in the month of October. That has come down to $37 right now. So that tells you there's not too much of physical buying happening into the markets. Also, when you look at major metals like copper and aluminum, which did decline 14 to 15% in the previous year, have started the first week of 2023 on a weaker note, down anywhere between 2 to 2.5% on your screens.
Thank you very much for that. Staying with the impact of falling commodity prices, OMCs are also on our radar as crude prices are now hovering around $78 per barrel. Sonal joins us for more on that. Sonal.
Thanks a lot for that. Well, yes, it's a definite positive for oil marketing companies, especially on the marketing side, because it reduces or it increases actually their marketing earnings as well. The second half of FY23 is expected to be much better in terms of their marketing segment versus first half, where they saw massive losses in this particular segment, and that would mean positive across the board as well. ICICI Securities, they put out some numbers in terms of what are they estimating in the second half. Now remember, in the first half, when I talk about massive losses in the marketing segment, IOC reported a loss of 28,000 crore rupees, BPCL 18,000 crore rupees, HPCL 16,500 crore rupees. This is just in the marketing segment. Now that crude prices have come down, this would mean that yes, it's positive also because oil marketing companies have not cut prices of retail fuel as well. So that would mean higher earnings in the second half, anywhere from around 13,000 crore rupees to 20,400 crore rupees. Now HPCL benefits the most here. It's because they have the highest EBITDA coming in from marketing segment, around 57% of its overall earnings. Additionally, HPCL is also in focus because of two updates. First, they have forayed into the petrochemicals business with pre-marketing of some brand polymers, and the HPCL Rajasthan Refinery Limited will be setting up a capacity of 9 million tons per annum. They have also signed an MOU with NTPC Green Energy Limited, and this is for foray or basically expansion into renewable energy. This would consist of energy storage projects, solar wind value chain, and electric mobility as well. So some major updates coming in as far as HPCL and the other marketing companies are concerned.
Okay, thanks a lot for that. Well, there's another impact that lower crude prices have, and that's on the tire stocks. So all the tire stocks are up today, whether it's Apollo Tyres, Balkrishna, CEAT, in fact, is now up almost about 4.5%. Now, both crude and rubber, the two key derivatives used to make tires, are both, prices have fallen quite a bit. Rubber prices, in fact, are down about 24% from the highs that we saw in April of last year. Crude prices are down 10% in the last two trading sessions and are down 40% from the highs of June in last year. So crude and natural rubber together make about 70% of the raw material cost for tires. Just to break it up for you, natural rubber itself is 50% of the operating cost. Carbon black is about 14% of the cost, and nylon tire cord fabric, or NTCF as it is commonly called, constitutes about 12% of the cost. Now, both carbon black and NTCF use crude as inputs as well, so there is a further cost reduction over there for tire makers. Now, the margins of these tire companies in any case have been improving over the past many quarters. So just to give you one snippet, Apollo Tyres, the margins in the last 3 quarters have gone up from 11% all the way to about 12%, and the expectation is that the margins would increase further, and hence a lot of these tire stocks are buzzing in trade today. Most are up about 3 to 4%.
Okay, let's slip into a very short break on that note. On the other side, we'll discuss market technicals. Himanshu Gupta of Globe Capital will be joining in.
Welcome back. As we were telling you, there are lots of buzzing stocks in trade today. So let's get straight to it. Himanshu Gupta of Globe Capital joins us for a quick technical check of the market. Himanshu, before I ask you about your view on the index, I wanted your thoughts on tire stocks, because as we speak, Apollo Tyres is sitting at a fresh 52-week high. In fact, that stock is up almost 5%, and the rest of the piece is also moving quite well. MRF, Balkrishna. Any thoughts here, and do you see more upsides?
Well, good morning to you. Well, absolutely. This is one pocket amidst the autos and the auto ancillaries pack that has been showing strength. And one stock that has been a clear outperformer here has been Apollo Tyres. Today, a fresh breakout on the stock above that 325, 330 congestion zone. I think this stock has legs more on the upside, and it has further scope to test levels of close to 350, 375 in the medium term. For somebody who is already holding on the position here, is suggested to stay invested. For fresh positions, one can initiate around current levels and add on dips towards 330. Keep a closing basis stop loss below 315, and I think targets of close to 360, 375 are on the cards in the very near term. And apart from Apollo Tyres, Balkrishna Industries, CEAT and JK Tyres, all these three stocks are also looking very good on the charts. And from a positional perspective, all three of them are looking good to invest. Now, talking about the technicals today, I think we are in a running correction in Nifty and Nifty Bank both. To me, the dip from the 18,200 to 50 odd levels, close to 18,000 is basically a running correction. And close to 18,000, 17,950, I see a strong support where I expect some buying to be seen. So I suggest to initiate fresh longs around 18,000 and 17,950 zone for a short-term perspective. Keep a stop loss below 17,900, which is the last support. And on the upside, I think one should not be surprised if we move above that 18,200, 250 in the days to come. Similarly, on the Nifty Bank, 42,650, 42,500, that's the very strong support zone. So as we are trading close to 42,750, I think another 100, 150 points dip cannot be ruled out. But around that 42,650, 42,600 zone, I'll be a buyer on Nifty Bank. And going ahead, I think 43,000, 42,200 in a day or two can be expected in Nifty Bank also.
Okay, and what about your individual stock picks as well, Himanshu?
Yeah, sure. So going with a couple of buy recommendations, autos, Nifty Auto is actually leading from the front today. So a stock that has been deeply oversold is Motherson Sumi. And now the charts and the technical derivatives data is suggesting that we can expect a short covering rally here. So Motherson Sumi is a buy around current levels of 75 odd. Keep a stop loss below 73, and the target of 80 and 82 looks likely on the cards in a day or two. Second one is a cash segment stock, a mid cap from a infra space, that is NCC, Nagarjuna Construction. I think is heading much higher from a positional perspective in a very, very strong chart formation here. So this can be bought around current levels of 93, keep a stop loss below 89. And from a short-term perspective, I think targets of 100 and 110 can be seen in the very, very short term in NCC.
All right, got it. Himanshu, thanks a lot for joining us with that quick technical check on the market. With that, let's now shift focus to some brokerage commentary on the outlook for various sectors. Sonia and Ekta are going to take us through what's going on in the auto space and also in the pharma space. This is a Jefferies note. So, Sonia, let me come to you first. They're sounding quite optimistic.
They are. In fact, Jefferies has a very bullish note that's coming in on the auto sector itself. So let's just quickly get that up on board for you. They believe that the auto sector is going to see big growth as we move into the new year. There are strong stock returns that are expected as well. Now, across pockets, now, these are diverse views coming in. On one hand, I just want to put it on board. On one hand, the Jefferies view is positive, while on the flip side, there's Nomura who's come out with a view that is quite negative on the sector. So there are diverse views. But Jefferies says that from the worst slowdown in decades, we are seeing a demand recovery come through across pockets, and hence they're factoring in an earnings upside as well. Now, they expect a 12 to 18% volume compounded growth across sectors, whether it's passenger vehicles, two-wheelers and trucks. This is from FY23 all the way to FY25, and they are also looking at certain pockets. So they see a strong top line growth with an improving margin performance, and that should fuel a double-digit EPS compounded growth for most of the OEMs. They also prefer the electrification theme, so that's the theme that they're looking at very closely. TVS Motor and Tata Motors, amongst all the incumbents, are the major players in this theme and will continue to benefit from that. Their preferred buys include TVS Motor, they like Tata Motors, they also like Eicher Motors, and they also prefer Maruti. Despite the slowdown that Maruti has seen in their retail sales, it continues to be a top pick for them. So very optimistic on the auto sector across the board. But I also want to put on board that, there are diverse views in the market. We also have Nomura yesterday coming out with a cautious report on the sector.
Okay, so that's the outlook on autos. Let's talk about the pharmaceuticals sector. Ekta is now joining in, and she's going to get us details from the notes from Bernstein and IIFL. What's their view for Outlook 2023?
Well, I'll start with Bernstein, which is said that, 2022 was a tough year for the Indian pharmaceutical space. Largely, we're back to basics in 2023, which includes ongoing price erosion to manage in the US, complex generics to rescue a couple of companies in the US markets, and secular return to volume growth in India. They expect margins to improve after what was a rather flattish 2022. Could start seeing some changes, such as improving cash flow for companies participating in Revlimid generic, higher capital allocation and OPEX spends in India. Sector valuations, according to them, are back to 10-year averages on a PE as well as an EV to EBITDA basis. Cipla, Sun, Gland are their top picks. IIFL outlook for pharma 2023 remains mixed. US generic market continues to be challenging, according to them as well. So they're estimating high to single digit to low double-digit price erosion. So high single-digit to low double-digit price erosion. Regulatory risk for export-focused companies has risen. Domestic Indian market is probably going to clock around 10 to 11% growth, and domestic-focused formulation companies will continue to outperform. For them, top picks include Sun, JB Pharma, as well as Torrent Pharmaceuticals.
Thank you very much for that. Get into a break. On the other side, we'll be joined by the management of Rama Steel Tubes to discuss the company's third quarter update. Welcome back. Important updates coming in on Vodafone Idea from sources where the impasse on Vodafone Idea seems to continue. Now remember, Vodafone Idea is sitting on a very large debt. It needs money. The DOT, or the government, had given them a chance to convert the interest on their AGR dues into government equity. So which would just bring, reduce the cash flow burden on the company, on Vodafone Idea, right? Instead of paying that quarterly interest or monthly installment interest amount, they don't have to pay it because it will be converted into equity, which the government will own. But now that conversion of the interest on AGR dues has been pending for nearly a year. The government had given its go-ahead in January of last year. So 1 year now, but there has been no word from the government on converting it, which basically means till then, the cash flow burden on Vodafone Idea remains very high. Instead, what the government has been saying is that they want the promoters to infuse some money into Vodafone Idea before the government can, look to convert that, interest on the AGR burden into equity. So the standoff has been playing for a while now. On one hand, the government is saying that we want the promoters to first infuse money into the company, while the company is saying that we want the government to convert, as promised, its interest on AGR dues into equity, and thereby alleviating the burden on the company. So this has been plaguing, the Vodafone Idea stock price. And now Ashmit has picked up some more details on what's transpiring over there. So let's quickly go across to Ashmit now. Ashmit?
Well, just for the benefit of our viewers, it was back in September of last year in 2020 when the cabinet had in fact cleared this proposal to convert equity, to convert government dues into equity. But the stalemate, it seems, has been continuing and seems likely to continue even further. The reason that is that from sources we've learned that Kumar Mangalam Birla met in fact the telecom minister as well as DOT officials, essentially to drive home the point that it is time now for the government to seriously consider to act on that decision of converting government dues into equity. However, the government has also clarified its position that the government says that it is critical for the founders and for the promoters to come forth and to infuse further funds into the company, and that any government decision to seriously consider and then to subsequently act on converting dues into equity will in fact be subject to a further fund infusion, a round of further fund infusion by the promoters. What is interesting, however, is that no commitment has been shared by Kumar Mangalam Birla on whether or not there will be any timeline or a certain quantum of funds that will be infused. So as a result, we see that both the sides are sticking firm to their position and are waiting for the other to act first. Vodafone Idea, on its part, is hoping for a fast round of government equity conversion, which will allow them to raise funds with investors. The government, on its part, is very, very clear that for any equity decision to be considered seriously by the DOT, it will be hugely relevant for the promoters to come forth and further infuse funds into the company. So the stalemate, essentially, as far as Vodafone Idea continues, no clarity in sight as to when this decision will be acted upon and give more clarity to the shareholders. Back to you.
All right, Ashmit, thanks a lot for that. So the stalemate over there continues.
And you know, while the stalemate continues, the company is losing a lot of subscribers. Its subscriber market share has been dwindling, and because no money has been infused into the company is unable to start its 5G rollout. Remember, you know, Bharti Airtel and and Reliance Jio have begun their 5G rollout. Jio has said that by Diwali of this year, they will complete a pan-India rollout, and Bharti Airtel had said by December of 2023. So they are fast-tracking their 5G rollout. But from Vodafone Idea, because there is no money coming in, it's been unable to move forward or press the pedal on 5G.
Oh, absolutely. Vodafone has been losing subscribers for 12 straight months now. And of course, you know, it's negative Vodafone and positive perhaps for other incumbents. Rel Jio in the last couple of months has added over 14 lakh subscribers as well. So it has been, you know, advantage the other incumbent players. But let's do one thing. Let's move on and talk about Rama Steel Tubes. It's on our radar after the company reported its highest ever sales volume in the third quarter. To understand this growth and what the management foresees in terms of the business outlook, Rishi Bansal, the director of Rama Steel Tubes, joins in to take a few questions. Rishi, thanks a lot for joining in. If I can just start by asking you about the quarterly sales volumes. This time it was 118% growth compared to what we saw same time last year. Can you tell us how much of this was exports, how much of this, you know, and what kind of growth do you see in Q4 as well as in FY24?
See, out of the entire growth what we have given in Q3, 20% was the export volumes. And 10% was the volume to the government sector, which we supplied to JJM, Jal Jeevan Mission. And balance 70% is the domestic volume, which was supplied to all the infra companies, automobile sector, and all the power sectors, and the domestic trade partners.
In fact,
and we foresee the similar type of a growth in Q4 as well, because there's a huge demand in the domestic sector. And even the prices which were falling from last 8 to 9 months, now the commodity steel prices have been stabilized. Globally, there has been an increase in the steel prices. So there's a huge demand what we see in the coming quarters.
So can you just give us the number? I think 9 months FY23, your sales volume was at about 1.3 lakh tons. Where will you end the year, and what is the number that you're gunning for in FY24?
We're expecting at least 25 to 30% growth in Q4 as compared to Q3.
And what would it take your FY23 volumes to? Do you have a target in mind? And what about FY24? Because you've got a Khopoli unit which recently got commissioned. So that will also add to your volumes and production. So can you tell us some numbers?
So in FY23, we are targeting somewhere close to 180,000 tons.
Okay.
And FY24, we are targeting somewhere close to 300 to 330,000 tons.
Got it.
On an annual basis. Out of which 50,000 tons will be a highly value-added product segment, where we're going to cater to solar segments.
All right, got that. Good morning and thanks a lot for joining us. Can you tell us where the order book stands right now? I think the last time we spoke, you said it was close to 150 crores, and you said that you're expecting to win a lot more orders. So can you tell us what?
At the moment, we have an order book of 280 crores.
280 crores. Can you tell us what part of this you're likely to start executing and what is the timeline for it?
We'll be executing these orders in next 45 to 50 days. And we're expecting at least 30% growth as compared to Q3 in terms of volumes. So definitely we're expecting further more orders in next coming months.
Okay. Is there a risk of a slowdown because of what's happening in the global markets? I mean, you are setting up facility in Nigeria and South Africa as well. And these are markets that have been hit very hard. Nigeria, especially because of the, the currency devaluation, etc. Is there a risk of a slowdown there?
No, we don't see any risk in the slowdown. Like we into a commodity, we into steel industry. In metals, there is a increase in the prices, and there's a sentimental increase on a global basis. So the prices, there is no risk as of now. From the last 9 months, we've already seen the bottom of the steel. So right now, the markets have been stabilized. So we see a very, very bright future in coming months.
Just to get that number right, FY24 volumes you said will be 3.3 to 3.3 lakh tons?
Yes.
Okay. And will exports continue to be about 20% of your
We're trying to increase the exports to 25%.
Okay, and
in
will that
FY23.
have any benefit to your margins? What are the export realizations versus domestic realizations?
In FY23, we expect export margins to be better than domestic margins.
All right, we will leave it at that. Thank you very much for joining us today and taking us through your outlook. That is the management of Rama Steel Tubes. They're sounding extremely positive on demand, saying that, export volumes were 20%. This is likely to continue going forward as well. Their order book currently stands at close to 250 crores, which will be implemented in the next 45 to 50 days. And they're not really seeing any slowdown even in their export markets, some of them which have been very severely hit. But Rama Steel Tubes says that they're not seeing any kind of slowdown there. So that is an interesting conversation. But with that, we're going to get into a short break now. On the other side, we discuss markets. We'll have Rohit Srivastava join us from IndiaCharts.com. Hey guys, welcome back. You're still tuned into Trading Hour. It is currently a 30-point cut that we are seeing on the Nifty. We had moved very close to the flat line, but we're back pretty much at the low point of the day right now, 18,013. Let's see if looks like we might even break that 18,000 level. But to discuss the markets, we are now joined by a guest. Rohit Srivastava, founder and strategist at IndiaCharts.com, joins us now to discuss the markets. Rohit, good morning. Thanks a lot for joining us. This is Pavitra. How do you see it set up now? For the past few days, all of this week pretty much, we have been facing resistance at that 18,250 kind of level. We do have the earnings season coming up, next week. We have the budget after that. Where do you think the market is headed? And do you think that usual pre-budget rally that we get is likely?
So, I started December by thinking that, we would see a possibly significant decline that month. But how December ended is that we didn't even see a 10% dip. And also by the end of the month, both in India and the US, we had the CBOE put call ratio and the volume put call ratio here both spike up pretty significantly, which means that the number of puts being traded relative to the number of calls that are being traded was very, very high. Now, that gives us one potential short-term oversold reading to really deal with. I think a lot of selling got done at the end of December, which therefore creates room for a near-term bounce back rally in January. And then, of course, like you said, we have the event of the budget, we have our earnings season, and all of that can actually aid some amount of this recovery. So I think there's a case that markets head higher from here. I would put support at for the Nifty at around 17,992. That's the previous swing low, or 61% of this initial bounce, closer to around 17,960. And the upside could be, at least to start with, 61% of the entire fall, which is around 18,460. So that is the risk reward we are really looking at in the near term. I think for the bank Nifty, similar levels could be around 42,600 to 42,300 on the downside, and around 44,800 to the upside. Now, 44,800 for the bank Nifty could actually end up meaning a new high as well. And but in the Nifty, we are still not thinking that till we really get past 18,460. So that's how we are positioning right now, thinking that there is a case for a near-term rally, and then we'll watch out whether it can extend a little bit as well. But initially look for 18,460 on the way up.
Okay, so there's a case for a near-term rally. And what do you think could lead to that if it does play out? You spoke about the bank Nifty, but where else do you see leadership on the upside?
So PSU stocks, I think, which have been attracting a lot of the attention, couple of pockets inside of that, could get attention. So I'm thinking of oil marketing companies in specific, because we've seen a lot of movement in oil prices recently. Even if they come down, spreads for OMCs can actually go up. So that's an interesting place within the PSU lot. There are also stocks like within the oil, ones like Reliance or ONGC, which could see interest coming back because of that. The other place to think of, which is more defensive in a market where we are still thinking that, interest rates are still being hiked and there could be a slowdown, is to look at pharmaceuticals. You've seen a 50% retracement in the pharma index after the rally it saw in the last 2 months. I think that's one defensive place where money may get allocated given the risks that people see ahead. And so it may be good to have some allocation towards pharma from a slightly more medium-term perspective.
Okay. Can you tell me the level that you see on the Nifty on the way up, Rohit?
So 18,460 is
Okay.
what I'm looking at to start with.
All right. And in pharmaceutical, what is it that you like or you're betting on? Because, you know, pharma has seen very divergent moves. On one hand, you've got a Cipla, which has done well. It's been resilient. But on the other hand, you've got Lupin, which has been a drag. So which ones in the pharma sector would you bet on, the stocks?
Yeah. So while I mention stocks, I just need to mention that, you know, we don't do any advisory. So whatever interest I'm showing is more personal. So I do see a good setup for, you know, stocks that are beaten down, you know, the likes of Lupin, Wockhardt, for example, where we've taken some interest. They've retraced almost 80% of the gains they'd made, or 90% of the gains they had actually made in, 2008 at the beginning. So that is also interesting. At the same time, you have leaders on the other side, which have done well throughout this time frame, like Sun Pharma, which is also an index stock. So it could be a mix of these. One could also then delve into some mid-cap space stocks that are showing relative strength. So it could be a mix of things. Even say Dr. Reddy, if you talk about, it's actually done nothing for a pretty long time. It's just slower. It's just a slower mover. So we haven't taken any interest there, but I wouldn't rule out that it can actually pick up some momentum because it's retraced, I think, 61% of the gains that it made in 2020-21, and given that it can find support and pick up as well.
All right, that is on the pharma space. Rohit, the next space I want to ask you about is just what we're seeing with crude. You know, right now it's under 78. Where do you see this headed? And then would you play this? Would you look at the OMCs or any of the oil companies based on what's going on with crude?
Yeah, so I did mention the OMCs are a very interesting setup. They've been underperformers for a long time, I think many years now. But they are closer to the bottom end of their 2-year, 3-year ranges. So therefore, the risk reward is pretty favorable. And falling oil prices will help. So what I think is happening to oil is the recent failure for it to really get past, $85, $87 means that we may be heading back to, a much lower level, maybe closer to $60, $62, which is from where that last rally started, more than a year back before we got the Russian crisis and then we crossed 100. So I think there's a case that, prices actually go back down there. And that could, OMCs are an easy bet on that as a beneficiary of that trend.
Okay, all right. We'll leave it at that. Thanks a lot for joining in and have a great day. Let's slip into a quick break. Up next, Microsoft CEO Satya Nadella tells CNBC-TV18 that India is an exception in the challenging global scenario. He also warns of a very difficult 2 years for the tech sector. Excerpts from that conversation coming up in just a bit. Stay tuned.
Hello and welcome to our special segment, Global Spotlight. Well, it's the new year, but the problems are still old. Layoffs continue in the technology sector. Amazon, which is the largest employer in the United States, has said it will hand over pink slips to 18,000 employees. Remember, in the month of November, the expectation was that Amazon would lay off 10,000 employees. But that number is now seen a lot higher at 18,000 employees. But one point to note is that these cuts will largely impact the company's e-commerce and HR teams. It's not the traditional tech employees who are involved in digital transformation or cutting-edge research who have been handed over the pink slips. Let's move on. The other set of depressing news came in from Salesforce, another tech giant who said that they plan to cut jobs by 10% and also close some real estate offices. The company's chairman and CEO, in a letter addressed to the employees, said that as revenue accelerated through the pandemic, we hired too many people, leading into this economic downturn we are now facing, and he takes responsibility for that. Well, the move also comes as Salesforce is getting pushed by Wall Street to bolster its margins. Remember, the company has committed to 25% operating margins by calendar year 2025. And when the news broke out yesterday, you had the Salesforce stock closing higher on the back that, now that the company is reducing its employee base, its costs come down and therefore margins are likely to improve. The question right now is this considered downsizing or is this considered right-sizing, right? They had a bloated employee base, but now they don't need that many people and therefore they're bringing their employee size right to the size that they want. So would you call it right sizing or would you call it downsizing? And another question is, why did tech companies get their hiring so wrong, right? Hiring so aggressively during the pandemic that they now need to course correct. But even as we await the answers to that, the next 2 years are expected to be challenging for the technology sector after the pandemic-fueled growth. That's the word coming in from Microsoft CEO Satya Nadella. This is what he had to say in his conversation with CNBC-TV18 Shireen Khan. Listen in.
Many CEOs are now talking about having to respond to the new economic reality. What is that going to mean, not just for Microsoft, but for the tech sector in general? Are we likely to see more pain, especially when it comes to retrenching, downsizing, margins going to be under pressure, guidance going to be a downside risk to that as well?
I think overall, quite frankly, whether it's for us as Microsoft or the tech sector, it's going to be very, very important to look inside and say, are we as efficient as we need to be competitive? I mean, at the end of the day, just because we are a technology company doesn't mean that we are the most efficient at what we do. And so as the paradigm has changed, as the bar has risen, we have to measure ourselves with the new bar. So definitely and also the growth picture has changed, we have to have operating expenses that need to be aligned. So definitely we are going to look at all of that, and it means that we're not sort of immune, as I said, to the global changes. But the one interesting thing to your point, though, is tech industry employment is not tech employment. Yeah. That, I think, is the key divergence that needs to be well understood, because that, I think, is positive, by the way, for the tech industry long term. Because if you look at it, overall tech jobs is actually increased. The tech jobs now are coming in financial services, in energy companies, in retail, manufacturing, and that's healthy because in the long run, all those employees in all those industries are going to consume more tech infrastructure, right? When we think about our cloud business, long term we're bullish because of the fact that there's more employment outside of the tech industry of technical talent. And so that's, I think, what we are banking on.
No, I think you underscore the labor market resilience aspect. But, what we've seen, especially as far as the stock markets are concerned, and I know that CEOs often say that don't focus on what the markets are telling you, but they seem to be suggesting that there is significant pain in store for the tech sector. How do you read what's happening with the way that the markets have corrected, specifically the tech stocks, and what that signals?
For me, look, I'm never the one who would ever say ignore the market, because the markets are smarter than us all. I think they are reflecting on is, look, where is the growth coming from? And how should we think about normalizing for that growth? And so I think stock performance, economic performance are not exactly the same. But the key for us as a tech industry, I always go back as a percentage of GDP. The simple question to ask is, do we think tech spend will increase or decrease? If we believe software and digital infrastructure is going to be important in construction, in energy, in manufacturing, long term, then you have to be long on tech industry. But will we have to go through our own cycles around productivity? Absolutely, like anybody else. But that's at least my perspective. I wouldn't look, the only reason why I would say ignore the short term is because in the long run, we would be fine with demand. But in the short run, what we have to focus on is our own productivity and making sure we are at the efficient
How
frontier.
would you quantify short term and long run?
I would say the next 2 years are probably going to be the most challenging because after all, we did have a lot of acceleration during the pandemic, and there is some amount of normalization of that demand. And on top of it, there is a real recession in large parts of the world. And so the combination of pull forward and recession means we will have to adjust. And that'll cycle through the demand cycle and, in fact, come out of it with what can be another massive growth cycle for the tech industry.
Okay, that's a very important interview. Actually, you can catch excerpts of that exclusive conversation all through the day only on CNBC-TV18. That's Satya Nadella talking about a challenging next couple of years, especially for the big tech industry in the US and the tech cycle globally. So do keep your eye out on that. With that, it's a wrap on Trading Hour. Thanks a lot for watching, though. Stay tuned. Halftime report comes up with all the big buzzing stocks of the day.